All right, today we're going to break down two concepts that are, well, pretty fundamental in trading, but when you put them together, you get a seriously powerful entry model. We're talking about liquidity and market structure, and how they can literally help you see the market's next move before it happens. So, what if you could actually anticipate what the market's about to do? And I'm not talking about some crystal ball, right? It's all about learning to read the story that the chart is telling you. It really isn't magic, it's just about knowing what clues to look for. And reading that story really just boils down to two key ideas. Think of it like this: market structure, that gives you the direction. And then liquidity, well, that tells you where the price is getting pulled. And that's the formula right there. That's what we're digging into. When you combine the blueprint, that's your structure, with the fuel, that's your liquidity, you get a repeatable plan for a really high probability entry. Okay, first things first, let's talk about market structure. I want you to think of this as the market's map, okay? It literally shows you the overall direction of the trend and helps you decide, should I be looking to buy or should I be looking to sell? At its core, the market really only does two things we can trade. It goes up or it goes down. So in an uptrend, you get this classic pattern, a series of higher highs and higher lows. The game plan here, it's simple. You look for buys. Now in a downtrend, it's just the mirror image. You get lower lows and lower highs, and that's our signal to focus on selling. So you might be asking, how do we know a trend is still, trending? Well, we watch for something called a break of structure, or BOS for short. This is that super important moment when price smashes past a previous high in an uptrend or a previous low in a downtrend. It's basically the market shouting, hey, the momentum is still going this way. Now, a trend is never just a straight line, right? It has a rhythm like it's breathing. It's made of these powerful, impulsive moves. Those are the ones that actually break structure. And then you get these weaker corrective moves or pullbacks. And it's those little pullbacks that are so crucial because they set the stage for the next big push in the direction of the trend. But hey, we all know trends don't last forever. So what's the first big red flag that things are about to change? It's when a key structural point gets broken. So for example, in a nice, healthy uptrend, price should keep making higher lows. But if it suddenly breaks below that last higher low, boom, that whole bullish structure is in jeopardy. And that's our clue that we might be about to flip into a downtrend. Okay, so if structure is our map, then liquidity is the fuel. Or maybe think of it like the destination. It's the money that the market is constantly hunting for, pulling price toward these really specific spots on your chart. So what is liquidity, really? Well, in the simplest terms, it's just a bunch of orders, a pile of money, all sitting at a specific price level. Seriously, think of it like a giant magnet. The market gets drawn to these zones because that's where the big institutions, the big money, can get their massive trades filled without causing too much of a fuss. So where do these big pools of money hang out? Well, they almost always gather just above old highs and just below old lows. And it happens for two main reasons. First, you've got tons of traders placing their stop losses there, right, to protect themselves. But at the same time, you've got another group of traders placing breakout orders there, hoping to catch the next big move. You put those two groups together, and you get this massive pile of orders just sitting there, waiting to be hit. And check this out. It gets even more interesting. When the market creates what we call equal highs or equal lows, that super obvious looking resistance or support level, that pool of liquidity becomes even more powerful. Why? Well, because now you have a huge number of retail traders all looking at the same thing and putting their stops and their entry orders in the exact same spot. It's like painting a giant target. All right, so now it's time for the fun part. Let's put it all together. We're going to combine our map, the market structure, with our fuel, that's the liquidity, and build ourselves a clear step-by-step trading blueprint. Okay, here's the playbook for a bearish or sell setup. It's 4 simple steps. Step 1, you have to identify a clear bearish trend. We're talking lower lows and lower highs. Step 2, you hunt for that pool of liquidity. See those equal highs? That's our target. Step 3, this is key. You wait for price to spike above those equal highs. This is called a sweep. It's grabbing all that money. And this move often pushes right into what we call a supply zone. And then step 4, that's our signal. We look to sell from that zone because we expect price to reverse and continue its journey down. Okay, hold on. I know what you're probably thinking right now. You're saying, wait a second, didn't you just tell me that breaking a high means the trend is changing?
And that is an excellent question. Honestly, the answer to this is the absolute key to making this whole model work. And it all comes down to context and intent. A true break of structure, like on the right, is a confident move that actually signals a potential trend change. But a liquidity sweep, that's different. It's a fake out. Its only job is to quickly raid all those orders sitting above those super obvious equal highs. The goal isn't to start a new uptrend, it's to grab fuel to power the next leg down, all while that bigger bearish picture stays completely intact. Okay, theory is one thing, but let's see how this actually works on a real chart. Enough talk, right? Let's walk through a trade step by step and see this whole model come to life. So, here we go. Check out this chart. The market was in an uptrend, right? But then, look at this. We get this massive push down that breaks below the last higher low. That's our break of structure. That's signal number one. The game has changed, and we are officially looking at a bearish trend. Okay, so after that big break, the market kind of chills out and goes sideways for a bit. It consolidates, and this is where you have to pay attention, because look what's forming. A really clear resistance level with several taps. Bingo. Those are the equal highs we've been talking about. We now have our target. Next up, we need to find our entry area, our supply zone. And you can see it right here. It's that last little up candle just before that huge downward move that broke the structure in the first place. This zone, sitting perfectly above our equal highs, is exactly where we want to be looking to enter. And there it is, the execution, just like we planned. Price rallies up, blows right past those equal highs, taps perfectly into our supply zone, and triggers our sell order. And what happens next? It reverses hard and continues the bearish trend. I mean, you just can't draw it up any better than that. So look, if you only remember one thing from all of this, make it this. Structure tells you where to look, and liquidity tells you when to pull the trigger. Once you start to really understand this dance between the market's map and its fuel, you'll stop seeing charts as just random noise. You'll start seeing the story. So the only real question is, after seeing this, will you ever look at a chart the same way again?